Okay, so good evening, everyone. Um, Today is the class 3 of this our class, and so far we have looked at 2 topics. When I started this class, I started with an overview of the syllabus. For those that are just joining us for the first time, my name is Wasil. Now I'll be taking you through the financial reporting syllabus. So usually the SBR guys usually join us today. Why they also have additional classes because for them, they are supposed to know everything in this your syllabus along with additional things they also have at their level. So they join us to pick up some things while we'd also move on. So, and that goes to you guys that you're just doing financial reporting. It's cut across. So you can never forget whatever it is I'm teaching you now because you are still going to need it again at, at the strategic business reporting level. So I laid down your syllabus to you, regulatory and conceptual framework, preparation and presentation of single entity financial statements, preparation and presentation of simple group, accounting standards, sustainability reporting, ethics and technological development in reporting, analysis, and interpretation of financial statement. So when I broke down this syllabus, I made you understand that this 3 part of your syllabus will take a lot of our time. It takes a lot of time to teach. So, and if you look at them, they are like 55% of your syllabus. It's material, no doubt. It's material, so it will take me more than 3 months if I'm not careful. So the approach we are using is I want to get some quick wins within the next 3 to 4 weeks, or even maximum 5 weeks. I want to take out 45% of our syllabus and almost 50% because usually this part is usually 20% in most cases, sometimes more than, right? So I want to take regulatory and conceptual framework, sustainability reporting, ethics and technology, then analysis. So that already is almost 50% of our syllabus. Now that would take me like 4 or 5 weeks to finish. So by mid-August, you should be able to conveniently go into past questions and solve many questions that you should be familiar with. So by August, I will jump into accounting standards. I would like 5 weeks, I'll finish it up. Then I go to group accounts, finish it up, then published. So by mid-October, we should be done with our syllabus and we're going to be very smart about it. And by first week in October, we'll also be doing intensive class, revision class, though not for you guys. Maybe for those that maybe have missed classes, have not been joining, and you need a crash program, that will be done in October to be a 5 weeks program where we just focus on past questions. But if you follow through with this class, maybe we have 3 hours class, 4 hours class at this stretch, then you will not really need that because we'll have covered all of that for you. So I started the class with regulatory framework. And basically, this is the first part of the syllabus. And what this part of your syllabus focus on is the regulation that governs reporting. And why this is important is that reporting is an highly regulated field because of the sensitivity of what we do is highly regulated because we are providing reports to providers of capital. And because ownership is usually separated from management, it's possible that the management might not want to provide the right to report to the owners. So That's why regulation is coming. That's regulation coming and to monitor and ensure they do the right thing. So for this first topic, we looked at the regulations and the regulatory bodies. So, and basically for the regulations, I call them GAP, which are basically accounting standards, company law, and local stock exchange listing requirements. But I told you that our focus is going to be accounting standard, which is IFRS or IAS. And by your syllabus, that is like 20% or 50% of your syllabus. So that's the part of gap that concerns us as accountants, as financial reporters. Then we looked at other things. Then we also moved to the regulatory bodies. I gave you quite a number of them, but we narrowed down to Financial Reporting Council of Nigeria, which is the body responsible for adoption, development, and enforcement of compliance to IFRS in Nigeria. And we looked at the objectives, we looked at the directorates and all of that. And I also mentioned some issues around FRCN, like the fact that they are the one that would be responsible, that in fact, that the fact that when you guys qualify, you have to submit your reports. You have to register with FRCN. All of you, you have to, it's compulsory. And also, every company is required to submit their accounts to FRCN, Financial Reporting Council of Nigeria. All directors that would sign the account of a company must submit, they must have an FRCN number, and a lot of other issues like that. Okay. Okay, somebody said my voice is skipping. Let me change my internet provider. Oh, okay. No, I was trying to. Okay. So, okay, fine. So, Aisha, I think you should look at your this thing and see. Okay. So that was basically
It's
what we
not
looked
me,
at
oh,
last
it's
week.
not me. I think it's someone else. I'm saying that your voice is perfect.
Ah, okay. Okay. Sorry. Okay, it's Victoria. Okay, so we also looked at IFRS foundation structure. And what the reason why we looked at these guys was that it's not the FRCN that actually develops the IFRS. There is an international body that does that. We call them the IFRS foundation structure. And we said it's a three-tier structure comprising of monitoring board, IFRS foundation, and standard setting bodies. We looked at each of them as well. And we also looked at standard setting bodies, standard setting process, the process involved in setting an IFRS from step 1 down to step 5. And I gave you an assignment. Where I told you to discuss advantages and disadvantages of rule-based and principle-based regulatory framework. And also I asked you to discuss the need why regulation of financial reporting is necessary. So, and these assignments, and I want to believe that every one of you have your notes that you write all of these things. So all of these things that I'm typing for you is actually in class, we dictate it, which is why I'm not reading material to you. I'm typing it by heart. It's like explaining just so that you can follow me through. So you are supposed to have it in your notes. So if me, I'm typing this live, there's no reason why you should not handwrite it. So I have two or three people that send this assignment to me. They also typed it. No, you are supposed to write it. You should have a lesson note that you're going to write this thing. So I need all of you to do this assignment. So if you have not done it, please do it. If you are coming to class the first time, you're supposed to research and send your solutions to us because that's really where we can have it. So if you have not done it, please let's go and do it, please. It's very important. And if you have looked through this, you will have learned a lot about regulation, this regulatory framework, because this regulation can either be rule-based or principle-based. So by the time you look at the advantages and disadvantages, then you would see things about rule-based framework. You will see why they are good. You will see why they are good. And you identify the fact that rule-based, yes, it can be rigid, it can it can give a like a checklist mentality, and people might just do what you ask them to do, not necessarily because they believe in it. People might find a way to even manipulate the system using rule-based, but it has its own advantages because things are very clear and written. Steps people are supposed to follow is there to be, I mean, investors will even be confident that it's difficult for them to bypass because the authority have told them exactly what they should do. And there won't be room for manipulation because everything is written. For rule, everything is written. So I really that I wanted you to research into it, write it down and share with me. So my number is on the group, right? I'm the one that you're chatting with. I'm the one that usually posts videos to all your group. I'm the lecturer here. So send it to me. No, don't type it. Write it in your notes. You should have a class note. And also this one is also a past question. 5 marks. Discuss the need why regulation of reporting is necessary in Nigeria. You will see that, I mean, just discuss, write something down yourself and see, you would be able to reason it out on why regulation is necessary. You see a lot of things. So I would have expected that these are the kind of things you'll be doing instead of um, thinking is the lecturer that is bad when you're supposed to be getting yourself busy. Now we move to another topic last week as well. We started conceptual framework. And I, in this introduction that I gave you for conceptual framework, we established that the conceptual framework is the theoretical basis that they use to develop IFRS, and they also use it to amend existing IFRS. It's like the foundation of reporting, right? That is like that's the ultimate because that's what they use in developing IFRS. In fact, when everything is scattered, where we don't know how to deal with an item, we come to the conceptual framework. Is the very foundation. Okay, but I made a point that when there is a conflict between IFRS and conceptual framework, is IFRS that will prevail, is the requirements in IFRS. So even though the conceptual framework is the foundation, it's what we use to develop IFRS. But when it comes to transaction level and the requirements of conceptual framework is conflicting with that of IFRS, the IFRS requirement for that transaction is what you will follow, not the conceptual frameworks. Though it's rare, but if it happens, I mean, we follow the IFRS. We looked at advantages and disadvantages. We looked at the purpose of conceptual framework. Last diet, this one was like 5 marks or thereabout. I would send you an assignment on this also today. You'll be required to do yourself. Mhm. So we then move to the content of the conceptual framework. So there are 8 chapters. There are 8 chapters in the conceptual framework, which we started last week. We looked at chapter 1 that talks about the objective of a general purpose financial report. And we said the objective of a general purpose financial report is to provide financial information about a reporting entity that is useful to potential and existing investors, lenders, and other creditors to enable them make decisions about providing resources to the entity. So I broke down this, I explained everything. We looked at financial information, and a lot of you, they have asked this one before for, I think, 3 marks or thereabout. So don't go and make mistake. I mean, these are the things you should never fail in the exam. That based on the conceptual framework, chapter 1, what financial information is provided to user. Find out that some students were saying statement of profit or loss, statement of financial position, statement of cash flows. Those are not the financial information. Those are just the structure, the statement that captures those information. The information itself is asset, liabilities, income, and expenses. So which we call economic resources of the entity, claims against those resources, and changes in the economic resources and claims. And I mentioned that this information, when you are providing it, it should be based on accrual basis of accounting. So it's the conceptual framework that came up with accrual basis. And that's why any IFRS, whatever the IFRS is talking about, the accounting treatment it will recommend will be based on accrual basis of accounting, except if there's an exception, which they will mention, like the statement of cash flows, for example, now. That one is based on cash basis. But every other one, accrual basis. An accrual basis of accounting is a way of presenting economic activity of an entity that captures the entire economic flow of transaction, regardless of whether cash is received or paid. It captures all your economic activity completely, right? So, and we mentioned some other things in chapter 1. We moved to chapter 2. We talked about qualitative characteristics of a useful financial report. We talked about fundamental characteristics, and we also talked about enhancing characteristics, and we explained quite a lot of things there, and I hope a lot. The As far as this conceptual framework is concerned, one thing I know is that they ask a lot of questions from chapter 2. You will see them asking a lot of questions from there. And we also were able to get to chapter 2 took us a lot of time. We did chapter 3. Chapter 3 is quite straightforward because it was just defining financial statement, reporting period, reporting entity, consolidated, and all that. We also did chapter 4, so we actually went very far. Oh, good. We actually went very far last week. So in 30 minutes, we should be done with conceptual framework. Now, based on what we did last week, do we have any questions? I'm sure every one of you here has access to these notes. You should have read it. So do we have any questions? Do we have any questions? Before I start what we have for today. Okay, no problem. So if you don't have any question, all right, let me quickly ask you something. Is there anybody here that can tell me in maybe 3 sentences the meaning of substance over form? Is there anybody here? Anyone?
It means that transactions should be reported based on their economic substance, not on their legal substance. Hello,
Okay.
sir.
Yeah. Okay, sorry. I didn't get your name. Sorry, what's your name?
My name is Mupelola.
Okay, Mokwe. Okay, so
Yeah.
you said that it means that transactions should be recognized based on their
Of
economic
their economic
substance,
substance, not their legal
not their
substance.
legal substance.
Yeah.
Okay. The exam out of 5, maybe they'll give you half over 5. Okay, who can get more marks? Anybody?
Hello, sir.
Yes, Evelyn.
The question.
I think I will just change the substance because that came from the question. I will say transactions should be recorded or reported according to their economic reality over their legal form.
Okay, so you would have gotten almost 2.5, like half of the mark, just for the fact that you did not repeat. You also repeated legal form, but the fact that you explain substance and you express it that, okay, follow economic reality, not legal form. You are also 2.5. Well, a wicked examiner will give you lower mark. A wicked examiner will give you something around maybe 2 self, because they will say you have not really mentioned so much like that. So they have asked it before, economic substance over legal form. I would have loved somebody to say it the way I said it. That is the kind of vibe I want to get from you. Vibe of you're studying. Like, but I'm not getting that vibe. Is there anybody that can impress me, that can wow me here? Anyone? Abigail, Amos, Aisha, Shama, nobody. Wow. Okay. So the
Can
way I, okay, please try.
I try, sir?
Yes, please try.
Uh, from my understanding, I think you should what the contract calls it.
Your line was breaking.
For the reality of what happened and not what the contract calls it.
Okay. 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 So you have also even broken it down further, which is also more impressive. So you have tried. Okay. Yeah, I can see your hand, Abigail. Please go ahead.
Okay. Um, I think it means transactions should be recorded in their economic reality and not agreements in the transaction, the legal agreements in the transactions.
Okay. Go ahead.
So the economics substance here refers to the parties that bear the risk, while the legal form is the contract of the transaction.
Good, 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 good. So you will have gotten more mark now because you explained the economic substance and legal form. So it's a common area in your exam. At FR level, they will ask you directly economic substance over legal form. At SBR level, when you get this application, that one is application, you will see when we meet, you will see the how it's asked at your level. So at yours, you need to understand it so well that you should be able to apply it. So if you want to, the way I gave you in your note, I was expecting somebody should come in and tell me this whole paragraph. Should come and tell me this whole paragraph because I simplified it, I explained it so well. So Abigail was close to that because she also went to the second paragraph. I told you that transactions should be reported based on substance and not their legal form. We now went to explain substance. That is the financial and economic reality of a transaction. It refers to the party that bears the risk and enjoys the reward in a transaction. Legal form is the letters of the contract or agreement. And I went ahead. That it's better to know that every transaction has a substance and a legal form. I said, where they are consistent with one another, no issues. But which is usually the case in most transactions. And I said, however, in rare cases where the economic substance is different from legal form, the transaction should be treated based on the substance. This is when you have really, and I gave you examples and I explained it in detail. If you
How
had
to it
watched
though?
the video, if you had watched the video, you need to mute yourself. I have to be I have to be muting most of you because I'm admin. I can just imagine if any of my other lecturers are teaching you. Is this how you'll be making noise? You cannot unmute yourself. You have to mute yourself if you want to, so that we won't be hearing your background noise. So, and I gave you examples and I explained it in detail and other things like that. Okay, so that's one question I wanted to ask you. Now, the second question that I want to ask you is this. Yeah. So when we talked about relevance, we talked about predictive value. We talked about predictive value. So is there anybody that can tell me um, examples of items in the financial statements that enables user to be able to make prediction? Example of items in the financial statements that enables users to be able to make predictions. Osuji, please go ahead.
Comparative info, 5-year financial summary, diluted EPS, presenting of material items, and discontinuing operations disclosure according to IFRS 5.
Fantastic. Nice one, Osuji. Very, very good one. That's very good. That's so good. So all of those shows that they enable user to be able to make prediction based on the report. Now, I explained chapter 4 to you last week. And one thing that I want you to make research on, I will not tell you because I want you to read further, is this. I defined income to you. Okay, yeah, Oluwatoyin, I can see your hand. Please ask your question. Oluwatoyin.
Yes, good evening, sir.
Oh, no, sir.
Yes, sir. Please, I'm sorry to take it back a little bit. Can you just explain this diluted EPS once more?
Okay, no problem. So one of the examples that Osuji mentioned, which we mentioned last week, about items in the financial estimate that enables user to be able to make prediction is diluted EPS. So one of the topic I'm going to teach you is in the syllabus of FR, is in the syllabus of SBR, is IS 33 that talks about EPS. So IS 33 requires that all listed companies must present basic and diluted EPS on their statement of profit or loss, like the very last item underneath their after the profit for the year or total comprehensive income, you have basic and diluted. Now, EPS means earnings attributable to each ordinary shares. However, the standard says that you must also present diluted EPS. And what diluted EPS means is that that there are some potential ordinary shares that are not ordinary shares yet, but the company has made commitment to them that we are going to give you shares, like share option. Those in SBR will know what I'm talking about. Share options, like convertible loans, right? Or convertible shares, like convertible preference shares. So we have made commitment to some parties that we would issue them shares in the future. So they are not shares now, but we are going to issue them shares in the future. So what diluted EPS looks at is that should we issue shares to those people? That means we'll have a larger number of shareholders. What will be the impact on EPS? What will our EPS be? Assuming our profit remains the same, or assuming that we make some savings and we are not paying them interest anymore, what will our EPS reduce to? That is diluted EPS. Considering potential ordinary shares, if they become ordinary shares today, what will our EPS reduce to? So that's what diluted EPS looks at. So you presenting that alone enables users to be able to make prediction that, okay, well, if this company issue shares to these commitments they have made to those people, to those shares they want to issue in the future, our EPS will reduce to this amount. That's diluted EPS. So at the very simplistic level, that's what it really looks at. So Oluwatoyin, did I help you in any way?
Yes, you did. Thank you, sir.
Okay, good. So, but it's a separate topic on its own. Like I was saying, a research I want you to make is this. If you look at the definition of income that I gave you, I said income is an increase in assets, decrease in liabilities that result in increase in equity, other than those relating to contributions from holders of equity claim. So I explained all of this, but I didn't emphasize on something. I just glossed over it. Increase in assets, decrease in liabilities is huge. Does this mean that all increase in asset is income? Does this mean that all decrease in liabilities are income? I think somebody asked it, and I just mentioned it briefly. So, of course, increase in asset that relates to additional assets, those ones are not income. They are talking about those other things. So, what I want you to research on is this. I want you to give me examples of increase in assets that is income. Also, examples of items that represent decrease in liabilities that we can call income. I need you to make that research and come back to me. The same thing applies to expense.
Please, sir, can you repeat that again?
Okay, I want you to give me examples of items, okay, that represent increase in assets that we can say is income. Okay, examples of increases in assets that is income, and examples of decreases in liabilities that is income. Okay, the same thing, examples of decrease in assets that is expense, examples of increase in liabilities that is expense. So just do your research, you can check online, check whatever. It's something we're going to discuss here. Okay, so I really need you guys to be studying well. If you check last diet, I'll give you one assignment when I'm done with this class. It's last diet question. And I don't want you to go and dub it. Really need you to. So what they asked last diet, the examiner was asking about this thing that I gave you here. Yeah. He was asking about Directorate of Accounting Standards. That was the duties of Directorate of Accounting Standards. What is the duties of Directors of Accounting Standards? A lot of students would say, what is this one? No, when is just so straightforward that they will be responsible. I don't want to tell you. I would send you as assignments, write something down, then we discuss it. Then you will have learned. And they are also telling us the accounting records that company must kept as required by CAMA. That CAMA 2020 requires that companies must keep accounting records. Even if you don't know CAMA 2020, but they are talking about accounting records. They are talking about accounting records. So even if all the accounting records you have learned in IFRS would suffice. So I will send that assignment to you today after this class, right? For you to be able to attempt that. Somebody is asking the question again, which of the questions now? Because I've mentioned a lot of questions here. Now, let's go to chapter 5 of the conceptual framework that talks about, Oluwatosin, which question? Okay, all the question. I will send it to you. I'll put it in this document, so they will all be here. They will all be here. That talks about recognition and the recognition. Recognition and the recognition. Sorry, give me 1 second. Sorry. Okay, so chapter 5 talks about recognition and the recognition. So this conceptual framework says that recognition is the inclusion of elements of financial statements, into the financial statements. Inclusion of elements of financial statements into the financial statement. So the following criteria should be met before an element can be included into the financial statements. One is where the elements is relevant and faithfully represented. Number 2, where the elements meets the definition, where the elements meet the definition of elements of financial statements. Okay, so what this is talking about, the conceptual framework is guiding us and saying that before you can include any item, any element into the financial statements, 2 criteria: where it is relevant and faithfully represented, and also where the element meets the definition of element of financial statement. If these are 2 are present, then you can go ahead and recognize the item. And if you check all IFRS that we are going to learn anyway, their recognition criteria follows through with this. It follows through with this. First is they look at relevance in terms of materiality. They looked at faithful representation. If it's faithful, then you can go ahead and recognize it. Or when it meets, this one is key. When that element meets the definition of those definition I gave you up there of asset, liabilities, and all of that. And for your information, these are definitions you need to know by heart. Like it should be as if, for you guys, it should be as if you are reading 1 to 10 for a primary 1 student. That's how you should know this definition. If I ask you define asset, I can just call Aisha, define asset. You should define it without, you should not even think about it. You should learn it so well. And it's better for you to start doing that when we have not done so much already. For everybody, I will share a question that they asked last night on these definitions. I'll share it with you also. So they ask a lot of questions in this area of your syllabus. The second one is the recognition. So the recognition is the removal. Sorry, just give me 1 second, please. Now, the recognition is the removal of elements of financial statements from the financial statements. And the following criteria should be met before an element can be removed or derecognized from the financial statements. Number 1 is where there is a loss of control of an asset. Number 2, where there is settlement of a liability. So these two, when they occur, you can go ahead and recognize the liability. And in all the standards we are going to be learning, they follow through with these requirements as mentioned in the conceptual framework. Okay, and that's all for chapter 5 of the conceptual framework. The next one is chapter 6 that talks about measurements. So measurements is the attachment of monetary value to the items recognized in the financial statements. So measurement is when you're attaching monetary value to the items that you recognize in the financial statements, then you're measuring it. So there are 2 measurement bases in financial reporting, or in reporting generally. There are 2 measurement bases that we have that is popular. What are they? We have historical cost basis, and we have current value basis. So these are the 2 measurement bases that we use in reporting as of today. So for historical cost basis, okay, this measures items at the price an asset was acquired and at the price a liability was originated. And this measurement basis, there are 2 measurement bases. And this measurement basis Does not change. Does not change. So as soon as you choose to use historical cost, it does not change. So if you buy your assets 5,000 this year and it's still in your books, you're still using it for the next 10 years, you still keep it at 5,000. Okay. So of course it has some very obvious flaws in the sense that the value might become irrelevant over time because the value will have changed, the value of things will have changed in the market, and you are still carrying the value of the asset at the price you bought it many years ago. So that's why they call it historical costs. It's the price the asset was acquired. But you see this current value basis, which most standards that are coming up, they are moving towards current value basis because of the limitations and disadvantages of historical costs. And what this does is it also measures items at the price they were acquired. But it usually updates the prices for inflationary impacts or current economic realities. So it usually reflects current economic reality. So if the price has changed, it will update. You can update your price to show the price now. If the price has decreased and all that, so that's current value. But for current value, there are three current value bases. Please, I need you to follow through with all of these things. These are pure things that a lot of students just ignore. There are three current value bases. Okay. One is we have current costs. So this is the replacement cost or the revalued amount of an asset or liabilities, and it is usually an entry price. So if you have an asset and you need to replace it today, and you want to know what's the value of that asset today, like a similar asset, that's current cost. And we usually use this when I'm teaching you a lot of standards like IS 16, IS 38, IS 36, even IFRS 9 and all of that. They make use of current costs. Okay. And that's where evaluation came from. And it's an entry price. It means that, okay, you want to replace these assets. You want to buy a new asset. You want to enter that market for that asset. So that's current cost. Another one, which is very similar to current cost, but they are not the same, is fair value. So this is the price that is received to sell an asset. So this is like selling price. So the price that is received to sell an asset, or if it's a liability, or paid to settle or transfer a liability. So it is usually an exit price. That's the difference between current cost and fair value. They are all current value basis of accounting. But for fair value is when you want to exit the market. You want to sell the asset. That's where fair value comes in. Okay, so the value or the money you will receive to sell that your assets That's the current value of that asset. If your current economic reality is that you want to sell these assets, the current value today is the selling price. But if the economic reality is that you want to replace this asset, that if I want to replace it, what's the value of this similar asset today? That's current cost. It means that you need to use current cost. So you need to understand all of these things, because as we move, so that you would know why each standard is saying that, okay, this is how you should measure this. This is how you should measure that. Because when I get to a lot of standards, some standard you say, okay, when you want to measure this asset, measure it at fair value. When you want to measure this asset, measure it at the valued amount. You need to know the reason, the brain behind it, and which is what this guy is explaining to us here. And the final one is value in use. And this is the present value of future economic benefits. Let me be more simpler. Of future cash inflows from an asset, including the inflow from its eventual disposal, including the inflow from its eventual disposal. That's value in use. So, and you see, value in use is typical. When you are not selling the asset, you don't want to replace it. You just want to know that, okay, if I continue to use this asset into the foreseeable future, what's the total value of these assets? What's the total benefit I can get all through the life of this asset? That's where value in use is popular. And the only standard where we talk about that is IS 36. When we are talking about impairment of asset.
Impairment.
Yes, impairment. That is the only standard where value in use becomes relevant. I mean, it's important that the conceptual framework mentions it, since it's the guide for all these standards. So you need to know, I mean, why we are using all of this like that. And that is chapter 6 of the conceptual framework. Now, chapter 7 talks about presentation and disclosure. Presentation and disclosure. Now, this one very straightforward. So this chapter focuses, on the need for items that are recognized and measured should be effectively communicated to the user. So we are saying, yes, you have recognized these items, you have measured it, so you need to effectively communicate it to the user. So it mentions a lot of things that ICANN will never ask you. They really do not, they don't even know how, I don't see how they want to ask that. It mentions things like principles for communication, how you should present items and all of that. But the main thing is that all income and expenses, he said, should be presented in the SOPL, while all unrealized income and gains should be recognized in the OCI. Additionally, assets and liabilities should be recognized in the SOFP. Okay. Now I have some abbreviations here. What's the meaning of SOPL? Anybody?
Statement of profit
Statement of profit and loss.
and loss.
Thank you very much. Statement of profits or loss. So they call it or loss. I don't know what.
Statement of profit and loss.
Okay. What about OCI? What's the full meaning of OCI?
Other comprehensive
Other
income.
Comprehensive income.
Thank
Other
you.
comprehensive income.
Other comprehensive income.
Other comprehensive income. What about this?
Statement of
Statement of
financial
financial
position.
position.
Statement of financial position. Okay, fantastic. Now, again, so this one is quite straightforward. But hey, Suji. Now, just for somebody, let me just quickly throw more light on this again. This one there's no big deal in this chapter 7 because you would really need this one a lot in this standard. Let me throw more light on it because somebody is asking. So again, historical costs, no big deal about that. It's the price you buy an asset or price that you borrow the liability. It does not change. It remains static. And to today, we still use it, even though it has some very obvious flaws. But for current value basis, this one is also, it starts with the price we bought it, but it's usually updated for inflationary impacts or for current economic realities. As things are changing in the economy, it is usually updated. And there are three bases. There's current costs, there's fair value, there's value in use. So current costs, that one is used when you need to know the value of your assets today, when your intention is to replace the asset. So what's the value today? If I want to buy a similar one. So current cost is an entry price. It's an entry price. It's used when the intention is you want to replace. The intention is if I want to buy a new one, you want to enter the market, you want to buy a new one. So that's where current cost is used. That's where you see things like a valued amount, which you are going to use in IAS 16 and IAS 38. Fair value. Fair value is an exit price, is a selling price. So if it's a liability, is how much is a settlement price. If it's a liability, it's a settlement price. So it's not the same as current cost at all. It's different. So fair value is exit, current cost is entry. Right? So for fair value, is either for asset is price you will receive when you want to sell. So meaning your intention is you want to sell. So you now want to know what's the value today. So the price you will receive from that asset, if you sell it today, that's fair value. So if it's a liability, the price you will pay today to settle the liability, that's fair value. But for value in use, so this one is an internal valuation done by an entity itself. You see, current and fair value, those are market determined. This one is determined internally by the organization. And the only standard that uses value in use as of today is IAS 36. And it's used when you want to know the value of your asset. If you continue to use it all through its life, that what would be the total value you can get from it? And it's usually derived as present value of future cash inflows, meaning that you will need to estimate future cash flows. You then discount that present value. That is value in use. So I hope I'm been able to help you with that. Now, back to chapter 7 that talks about presentation and disclosure, the one that catches my attention is this one. It says, all unrealized income should be recognized in OCI. So I think it's important for you to know that examples of unrealized income are, is there anybody that can help us with this? Anyone that can help us with examples of unrealized income? Sorry, what did you say?
Unrealized profit.
I can't hear you.
Revaluation surplus.
Thank you very much. Revaluation surplus.
Valuation surplus.
Any other one? Any other one?
Foreign exchange gain or loss.
Foreign exchange gain or loss.
Or losses, yes.
They are realized. Especially if you have dollars. You have dollars and the value of your dollar goes up. Is a realized gain. You can't call that unrealized because it's a monetary asset. So we have exchange difference on translation of a foreign subsidiary. So for you guys in FR, just take this example. Just take this example as an example. I'm not going to teach you this. Though I'm going to teach you foreign exchange gain. I'll teach you that in IS 21. But I won't teach you exchange difference on translation of foreign subsidiary. That's for SBR. I will teach you how to calculate this. There's also return on plan assets. This is relating to IS 19. It's also not in our syllabus, it's in SBR. There is also actuarial gains, right? This is also under IS 19 and a lot of other ones like that. So those are unrealized income. You do not recognize these types of income in SOPL. The conceptual framework says they should go to other comprehensive income. Okay, they put it because they are unrealized. Please remember these things. It will help you when I start teaching you all these standards. Now, this chapter 7 also mentions that an entity can recycle an item in the other comprehensive income into SOPL, meaning statement of profit or loss, if or when they become realized. Okay, except where the standard or where the IFRS relating to the item does not allow that. I mean, since the reason why we said that, Amarachi is asking that what are plan assets? Plan assets are things like stocks, savings in a mutual fund, or any other investment that you make, that you invest pension that you collect from your employees, that you're keeping for them, investment that you keep them into, they call them plan assets. Just to answer your question. So, as I was saying, when these items becomes realized, we are saying the reason why they are unrealized, that why they go to OCI is because they are unrealized, right? Because they are not real income. They are just book income. You say don't put them in P&L, put them in OCI. But they can become realized. For example, evaluation surplus now. The value of your asset goes up when you evaluate it. You are saying that gain is a book gain. Don't put it in P&L. But what happens when you sell the assets? It becomes realized. It becomes actually realized. So, but IAS 16 does not allow you to
Property,
take
plant, and
gain to
equipment.
P&L. It does not allow you to take the gain to P&L. Rather, it says take it directly to retained earnings. You will learn all that. So I don't want to go into so much details here now, because I know that when I start teaching you this standard, I will go deep into all of these principles. But just take it that these items that are unrealized, that goes to OCI, when they become realized, they can be recycled. So look at the terminology. These are terminologies that you need to get used to as a reporting student. That you recycle it. You take it from OCI, you put it in P&L. So you will learn some of these things as we move on. All right. So that's the end for chapter 7. Now somebody was gifts. I saw your hand. Can you ask
Thank
your
you,
question?
boss. Thank you, boss. I have a question. Sir, please, are we
All right.
going to continue with IFRS 2 today, or we'll leave it to Wednesday?
It's Wednesday.
Yeah.
IFRS 2 is not for this class.
SBR.
It's a combined class.
Okay, sir.
So yeah, it's an advanced topic. It's not for you.
So after, let me just watch. Don't worry.
Yeah. So this is just for the topics that are in your syllabus, and it's also in FR syllabus. So there are a lot of topics that are not in their syllabus that we cannot take in. Okay, so any other questions? All right, so let's look at the last chapter. So concept of capital and capital maintenance. So there are two concepts of capital, and they are, yeah. Bob Manuel, please, you can ask your question, please. Go ahead. Bob Manuel. Okay, don't want to ask again. Wow. And they are, and
Hello,
we
sir.
have the, yeah, please go
Yeah,
ahead.
yeah.
I'm
I want to
listening.
ask a question based on the recognition of asset, the recognition of when you're talking about the recognition. I wanted
Okay,
to
please.
ask when an asset is disposed, can we say it have been recognized from the financial statements?
That's correct, yes.
Because he didn't mention it when you were talking about the condition when something should be derecognized. So I want to get clearance on that.
Okay. That's a good question you have asked, Bob Manuel. So, when you dispose an asset, it falls under loss of control. Okay?
Yes.
So this one encompasses a lot of things. So we cannot be mentioning, so it's not disposal alone. If you have, let's say, if you exchange an asset with another party, you can derecognize it from your books. Or if an asset is fully depreciated, yeah, you might not necessarily derecognize it. IAS 16 says don't derecognize. That is not the recognition when you fully depreciate. But where you hold an asset for sale, for example, when you hold an asset for sale, you derecognize it from one end,
Yes, man,
take it to asset held for sale, like that. So there are a lot of instances like that. But the key terminology that encompasses all of this is loss of control. Okay, that's when you recognize it. Anytime you don't have control again, even a lessor that leases an asset out under a finance lease, he has lost control. He would derecognize it. Even though he didn't sell it, he just leased it to another party under finance lease. But if he leases the asset under operating lease, he has not lost control. He will still retain the asset. Right? So that's the main terminology we need to focus on. Yeah, Oluwatoyin, please ask your question. Yeah, wait, before Oluwatoyin, Bob Manuel, did I answer your question, Bob Manuel?
Yes, I'm
Bob
okay.
Manuel. Okay, good. Yeah, Oluwatoyin, go ahead.
Yeah, yes, sir. Oh, thank you so much. I want to ask if I classify an asset from, okay, let me say an item from being an asset that I'm using for probably for production under PPE, IS 16, and I move it to IFRS 5 for asset held for sale. Have I lost control?
Haven't you?
That's what I'm trying to get. It's
Yeah.
still in my possession. I've not sold it. I'm just moving. Okay, I want to sell it, and it meets the criteria of for selling it, but I've
Yeah.
not sold it. It's still with me. Have I? I want to know if I have lost, if control has been lost.
Well, not totally. Not totally. So for us here, even under IFRS 5, you are still using the asset. You are still using the asset. So even if you are still using the asset, you can still classify it as held for sale, right? Provided that you are looking for a buyer and all of that, all those other conditions are actually present. So yeah, we cannot totally say you have lost an asset, but I mean, to a large extent, uh, the there's a change in use, there's a change in nature, there's a change in circumstances as a whole. The very essence, the very use of that asset, what you're using it for, you have lost control in that end, and you would recognize it or you will reclassify it from the nature it was before. So if it was a PPE before, it cannot be PPE anymore. You take it out from there. You recognize it from there, right? Because you are not earning benefits as far because control means you are making money from that use. You are not making benefit from that use anymore. So as far as that use is concerned, you have lost control in that end. But now you want to now make money from selling. So it's now more like an inventory, right? Not an inventory, but it's like that. It's treated like an inventory because you now put it as current assets as a separate line item in your statement of financial position, right? So that's why I said we cannot totally say that you have lost control because the asset is still within your possession. And IFRS 5 also acknowledges the fact that you can still be using it. You can still be using it, right? So even though your intention is to sell it now, but you can. So I will not totally say we have actually lost control. But I mean, in terms of what it was and what it is now, there is a loss of control and control in another nature, as it were. Okay, so let's look at the final chapter here, which is concept of capital and capital maintenance. So we have the financial concept of capital and we have the physical concept of capital. So the financial concept of capital considers capital as the nominal amount of capital. Okay, that's financial concept of capital. And as of today, this is the concept of capital that is used in practice. Okay, when I say capital, capital is capital, the share capital that we have in our books. So chapter 8 is just explaining the concept of capital that we can have, how we can treat it in our books. So there is the financial concept, which is the concept we use today, we choose to use because it's easier. So we see capital as the nominal amount, which is usually the money introduced by a business. And this is usually determined as assets minus liabilities. So capital is usually seen as a balancing figure. So your asset minus liability gives you your capital, and that's financial concept of capital. The next one, which is physical concept of capital, considers capital as the productive or operational capability, as the productive or operational capability of an asset. Okay, so what this one looks at is, this looks at capital as the purchasing power of the nominal capital. That is what the capital can actually produce. So we don't use this concept because it's a little it's not a little, it's very complex. Because if you say you have 100 million capital, as of today, you just put it in our books as 100 million. But if you are using physical concept of capital, we'll say that 100 million that you have had since the beginning of this year, are you sure it's 100 million again? It will tell you, consider inflation. What's the value of that 100 million today? It would check that 100 million for inflationary impacts. It would remove inflation and say, okay, this is what your 100 million can buy for you. But it's not popular. It's not something we use today. That's why you not find it popular in your exam, because we don't use it, but it exists. That's concept of capital. The second one is a capital maintenance, which is the second part. So we can say that an entity has maintained its capital when it makes profits. So you have maintained your capital when you make profits. It's as simple as that. And there are two capital maintenance concepts. We have the financial capital maintenance, and we have the physical capital maintenance. The first one, which is financial capital maintenance, so this is where the capital at the beginning is higher than the capital in class at the end. This is where the capital at the beginning is higher than the capital at the end. So it's that simple. So if you have capital of 100 million at the beginning of the year, and at the end of the year it's now 120 million. You have financially maintained your capital. Okay, but for physical capital maintenance, this one is not just, it doesn't look at your money capital. It doesn't compare that. It looks at what it can buy. That if to compare your productive capacity at the beginning and at the end. If you say you have 100 million at the beginning and you have 120 million at the beginning, if we remove inflation from that your 100 million, from that your value at the beginning, is it what you had at the beginning? Or in terms of what they can buy? So the 100 million you have at the beginning, you can buy 100 units as at then. The one you have at the end, you say you have 150 at the end. Can you buy 100 units today? If you cannot buy 100 units of that same product again, then you have not physically maintained your capital. So basically, it just considers inflation. It doesn't ignore inflation. Okay? So this is where the productive capacity, let me make it easier for you. This one is too much grammar. This is where capital at the beginning is higher than the capital at the end after considering the inflationary impacts for the period. So it's either you look at your capital at the beginning and say it's 100 million, and you say your capital at the end is 150. Okay, no problem. What's the inflation for this year? Let's add the inflation to the capital at the beginning. Let's see if that will not go up to more than your 150 million. Or you remove inflationary impact from at the end and see where it comes to. But the reality is this. We don't do that. And it makes sense because a lot of people will prepare accounts. The account will prepare today. The account will prepare today. The profit you are seeing is not profit. It's not profit. Because the way we prepare accounts today is that you have sales of, let's say, 100 million. You would deduct your cost of sales. Don't forget, this cost of sales is historical cost of sales. So the amount you bought it long time ago, you say 80 million. And you would be happy and you will be celebrating a profit. You say you are making a profit of 20 million. You will quickly go and distribute dividend and say, we have, or shareholders will be happy and be requesting for dividend. Of course, after removing all of that expense, I know. But the reality is this. The reality is this. At the point where you say, at the year end, that you say your sales is 100 million, the cost of that same good is not 80 million anymore. It can be 120 million at the date you are preparing this account. So financial concepts, capital maintenance or concept of capital will record it at historical costs. It does not consider inflation. But if it were physical capital maintenance, it will add inflation to this. That was the price today. What's the price today? It will consider holding gain. That was the price. Is this 80 million actually 80 million today? Then I'll give you actual profit. So that's why when you see all these filling stations, as soon as there are changes in price, they will quickly update their price because they know that if they don't, they won't be able to restock because prices have gone up. They won't be able to restock, even though they bought at old prices. But since they said prices has increased, if they want to sell at old prices they bought, fine, but they won't be able to restock. They will go out of business. That's why, but people will be complaining. Why did they increase it? Don't they have old stock? It's okay. And that's the entire gist about conceptual framework. Now, let's look at past questions. That's if you don't have any question. Do you have any questions?
Yes, Mr. Wasiu, I don't really get your example on financial capital maintenance.
Oh, okay. That one is even more straightforward. So this one is, let's say your capital at the beginning is 100 million, and capital at the end is 120 million. So in this one now, you have financially maintained your capital because you have made a profit of 20 million. So if the situation is this, that's financial capital maintenance. You have maintained your capital because your capital at the end, at the beginning, is higher. Your capital at the end is higher than your capital at the beginning.
Thank you.
Aisha,
Thank you.
get it? Okay, so that's where this one is different. For this one now, this one will look at, yes, let's say your capital at the beginning, like I mentioned up there, is 100 million. And capital at the end is 120 million. This one will not say you have made profit. This one will say that what can this 100 million buy? If this 100 million could do 70 units, and this one can do 60 units, depending on the prices today, you will say you have not maintained your capital. You say you have not maintained your capital, or you just add inflation to this. You add inflation. If you add inflation to this beginning, you see that this 100 million will go up. It can even go up above 120. It will show you that you have not maintained your capital. This 120 is just this. The value of 100 million at the beginning is higher than the value of this 120 today. Or you just use units that this 100 million then could do 70 units. This your 120 can only produce 60 units. So you have not maintained your capital. So while this one is looking at just the nominal amount of capital itself, this one is looking at your productive capacity by considering inflation. That's all this guy is looking at. Any other question? Any other questions? Okay. Yeah, but Manuel, please go ahead. But Manuel, you're muted.
So can you move up a bit? Okay. Okay, yes, I'm okay. I wanted to ask, can you give a practical example on this practical concept of capital and practical concept? I don't get it very well.
Okay. So, like I mentioned, I told you that the way we prepare our account today, right? We use financial concept of capital, meaning we put share capital as our assets minus liabilities. So when I start teaching you all these accounts, you see the way we get capital is we'll put share capital, we'll put the value there. It's just the money you use to, in fact, the way we do it, share capital is your share capital in your CAC that you register with CAC. That's financial concept. So it looks at capital as the money that you use to start that business. So that's financial concept, which is what we use today. But for physical concept of capital, which is not popular today, what that looks at is productive or operational capability of, of an entity. Not of an asset, of an entity. So what this will have looked at, instead of just looking at the value of your capital is the money, this one will have looked at capital as the purchasing power, what the capital can produce. And what that means in terms of money is that it will have considered inflation. It will have considered inflationary impact on that capital. For example, if you have your capital as 100 million, and that 100 million is what you have, what you bought in since 2-3 years ago. Physical concept of capital will tell you that this one, your 100 million is not more than the value has eroded. Please, you need to always mute yourself, please. So this one usually consider the inflationary factor. And I mentioned that why you might not see so much of this in the exam, physical concept of capital, is because it's not used in practice today. All organization uses this because this is very complex to apply, because we will need to start identifying the inflation that has affected all our expenses. Because we accountants, is money that we have spent, that people have spent, that we record. So that means we will need to start getting what's the value of those money today. That if I want to buy those things today, what's the value today? That's what we will now recognize today. That is what physical concept of capital wants us to do. What's your productive and operational capability? So it makes preparing an account very difficult. I don't see us ever using it, except maybe when AI comes, and you can use AI to prepare accounts, and it can automatically get current prices, then translate our account using physical concept of capital. That's fine. It's okay for us. So, Bob Manuel, did I help you?
Thank you. I'm okay.
Okay. Now let's solve past questions. So this one was in 2020. It says the regulatory body responsible for issuing accounting standards in accordance with local and international regulations in Nigeria is the FRCN. We know that. It says explain 3 main objectives of setting up FRCN in Nigeria and identify 2 ethical issues in financial reporting which companies may be sanctioned for. I already taught you this. I told you that one of the first objectives of FRCN is to protect the interest of investors and other stakeholders. And they also guide us on issues relating to corporate governance and financial reporting. And they ensure that financial report is reliable and relevant. And they ensure that companies adopt best corporate governance practices, and they ensure there's an improvement and credibility. It improves the credibility of our reports. And I gave like 7 points in your note. They also say identify 2 ethical issues in financial reporting which companies may be sanctioned for by FRCN. Can anybody attempt this? 2 ethical issues in financial reporting which companies may be sanctioned for by this FRCN. Okay, yeah, Suji.
Okay, I think I can only give one reason, one issue. And I think if the companies are not registered under FRCN, if they don't have their FRCN number or something, yeah, that's the only one I can think of.
That's correct. That's very correct. See Amos. Amos, in the mind of Amos now, I
If the
think
account
in the
like
class.
somebody that does not have FRCN number.
Thank you very much. Thank you very much. That's absolutely correct. If it's signed by somebody that does not have a FRCN number. Any other person? If you fail to
Failure
submit your
to
account. Yeah,
failure
Jeremiah,
to
continue.
submit internal control framework to the FRCN.
That's correct. That's correct. And even if you don't submit your account with FRCN also. Yeah, Moses, I'm with you. Go ahead.
Maybe concealment of liabilities or fraudulent financial reporting. Because some people may hide their liabilities just to show that their business is a going concern, that not knowing that it's actually dying.
Okay. Okay. So what will actually give you mark is if you say non-compliance with the IFRS, with the requirement of IFRS.
Okay.
Non-compliance. So yes, what you have mentioned to a large extent is right, but caption it under non-compliance with the requirement of the IFRS. Okay, fantastic. You guys have made very important points. I think I gave you this as assignments. It says non-accountant usually wonder why entities general purpose report should be regulated without allowing users to be free from choice of presentation. In order to give clarity on this subject to non-accountant professionals in your workplace, you are required to explain 4 reasons why financial reporting should be regulated in Nigeria, identify and explain 2 sources of accounting regulations in Nigeria, highlight 3 objectives of IASB and all that. So these are past questions. So this one, I gave you this as assignments. Explain 4 reasons why financial reporting should be regulated in Nigeria. Can we come up with 4 reasons?
Okay, can I?
I think.
Yes, please, go ahead.
Okay, one of the reasons of the regulation is that to protect the interest of investors. And secondly, if financial reporting is not regulated, so comparability will be difficult because everybody will be using different bases, and at the end of the day, it's very difficult for you to compare. So I think for these 2, I will stop here. Okay.
Fantastic, fantastic. You have mentioned very good 2 points, very strong points. Any other person? Any other reason why it should be regulated?
Yeah, to maintain uniformity in reporting.
Uniformity is not the same thing as I agree with you, they'll give you your points, but it's just so similar with comparability. But when there is uniformity, it ensures we can compare. So, and I can see Toluwani also mentioned to build trust, credibility. That's also correct. To build credibility, financial report. That's correct.
To prevent fraud and financial crime.
That's absolutely correct. That's absolutely correct. Okay, so yeah, so you guys are
To avoid window dressing. To avoid
Again?
window dressing. Window
To
dressing of
avoid-
financial statement.
That's correct. So avoid creative accounting and window dressing. Okay. Yes, to directors and auditors accounting. Yeah, perfect. You guys are making sense. So let's move to the second one. So identify 2 sources of accounting regulations in Nigeria. Anybody?
Okay.
Accounting standards.
Yes.
Thank you very much. Accounting standards. What's the second one?
Company and Allied Matter Act 2020, CAMA.
No, that's just an example of a regulation.
Company law.
Company law.
Company law. Company law.
Thank you.
Local stock
Local
exchange.
stock law.
It's
Yes.
listing requirements, okay? You can even give them the 3, even though they are asking for 2. Since you know the 3, give them the 3. Let the guy choose the 2 he wants. So also they're asking 3 objectives of the IASB. 3 objectives of the IASB. I think I gave you 4. I didn't directly give you the objective of IASB, but I actually gave you the objective of IFRS Foundation. And I told you that IFRS Foundation delegates their responsibility to the IASB. That therefore means that the objective of the IFRS Foundation is also the objective of the IASB. And before I gave you R, I told you that to develop in public interest a single high quality accounting standard. Number 2, to promote the use and rigorous application of the accounting standard. Number 3, to take care of the needs of SMEs and emerging economies. Number 4, to harmonize and converge international accounting regulations. But they asked for 3, give them 3. And so these are the kind of questions. Now this is 4, 3, 3. These are like 10 marks. This one too is 10 marks. These are the kind of questions you should do. And that's why a topic like this is so important. It's something you need to read and read over and over again. Now, this one, they said international financial reporting standard may either be premised on principle or rule. You are required to explain principle and rule-based concept for 7 marks. So for this one now, you're supposed to explain that rule-based concept is a regulatory framework basis where the concepts are strict, written, and they don't usually allow the judgment of the users. Examples are the financial reporting standards of the US, the company law, and the local stock exchange listing requirement. You then say principle-based provides concepts, provides general guide on how items are treated. It therefore allows entities and users to apply their professional judgments. Examples of principle-based concepts is the IFRS or IAS. And that's it. So all I've done is to explain what principle-based concept means and rule-based concept, and I gave them examples, right? And that gives you your 7 marks. You are now asked that you should highlight the 3 basic steps or processes necessary for developing a new IFRS. Can anyone try this one? Steps in developing IFRS or accounting standard. You have forgotten step 1, agenda consultation, where they come up with a work plan. Step 2, research program. Yes, where they come up with a discussion paper. Step 3, we have
setting program.
Standard setting program. Yeah, where they come up with an exposure draft. Then there's the issuance of the IFRS itself. And there is the maintenance program where we carry out the post-implementation review. But they ask for basic 3 steps. You can give them the 5 if you can. Just so that you can get all your points. Or just give them the 3 and move on. This one was a repetition. They already asked this before. Objective of FRCN. So we can leave this one. This one is at the professional level. They say, what are the major benefits and criticism of principle-based? This is the assignment I gave you. Advantages and disadvantages of principle-based framework. So I really need you to go and do that assignment. So for those guys doing SBR, it's even much more important for you because they give you a lot of marks on questions like that. These are the kind of questions you see in your exams. So get the benefits and disadvantages of principle-based. And also they're asking us, what is the consequence of transitioning from rule to principle-based reporting? right? Of course, one of the consequences is transition costs. Okay, so what they are asking is basically here the consequence of when you transition. So you can give them the advantages of rule-based, what you are going to be losing when you are leaving rule-based framework. Because this one is asking for advantage and the advantages of principle-based. So this one give them the advantages of rule-based. And there are other ones that you can give them when you leave rule and you are going to principle. Just tell them these are the things they will miss. All the advantages of rule-based, the fact that there won't be clarity anymore, the fact that people can easily then manipulate the reports, the fact that there will now be high legal costs for people. There will be high compliance costs because now people can use their judgments and all that. So get those advantages and disadvantages, then you'll be able to answer this one. Another one, we're asked that appraise the rationale behind different regulatory framework for corporate financial reporting. Okay, who can tell me this for 8 marks? Anybody in SBR that can tell me what is this talking about? Appraise the rationale behind different regulatory framework for corporate financial reporting. Anybody? Okay, nobody. So what this is talking about is
I think is to in accounting, then to protect the yes.
okay. So what I can't hear you anymore. So what this is really talking about is the second assignment I gave you. The reasons why regulation is necessary. So I heard you say to protect the interest. You are correct, actually. But it would, be able to interpret that what this question wants from you is to tell us why regulation is necessary in Nigeria. Right? The rationale behind different regulatory framework for financial reporting. So you do the assignment, that means you'll be able to solve this. Also, we are asked to analyze the various sources of regulation. So this one, they're asking us for sources of regulation, the accounting standard, but they want you to analyze it in detail. So you see, at professional level, even though they have asked the same question as skills level, the way they ask it for skills is different. You see them saying explain, identify, right? Identify. But the way they ask here for professional is like they want to hear your opinion and view. So that's why I say skill exam is easy. When you get to professional, that's where you must be able to build points, right? So when I'm sharing these notes with the professional guys, I will have put the solutions for you here. But I will really want you to, I will show you how you would answer questions like this in detail. Because like this one, they say, what are the major benefits? So they want you to build up a case, relate it. This one, what are the consequences? This one, appraise, analyze in details, right? Look at the way that's how your question are asked for you guys. Now, another one is, yes, Aremu, yeah, you're on point, Aremu. So this one was in 2020. It says the conceptual framework specifies fundamental reasons why financial statements are produced worldwide, which is to satisfy the requirement of external users. Required, outline five types of economic decision for which financial statements are likely to be used for, and identify 2 advantages of conceptual framework for 10 marks. 10 marks. So this one also is already the solutions. You'll find it in this text. And I also, when I was explaining it yesterday, I also gave it to you. Economic decisions that are made. And they were very specific. So, because they made mention of conceptual framework. So when you're talking about economic decision, you should be talking about economic decisions that are made by those primary users. If you remember, I emphasize that we have 3 primary users. We have the potential and existing investors, lenders, and other creditors. So when you're telling us the economic decision, we want to hear the economic decision that is made by those people. So if you check your notes, you'll find it there. Okay, the investors make decision on whether I should give you more money. You make decision on how to vote during AGM, whether I should fire you or not. For lenders, he wants to make economic decision on whether he should lend you more money or whether he should liquidate the business, right? For the creditors, he makes decision on whether he should give you additional goods or whether he should engage a factor to pursue you to get his money that is with you, right? If that is if you're not paying anyway. And they are also asking that you should identify 2 advantages of the conceptual framework. I gave you like 3 or 4, I can't remember. But one of them is it makes the development of new standard consistent and coherent. And also it makes users understand that reporting is based on a common ideology. And it helps in the treatment of unusual transactions. And it prevents political interference. This thing has to be on your head. If they ask it, you give it to them. Like, so simply. Here, they were asking that in Nigeria, financial statements are reported in more detail in both words and figures. Following the introduction of IFRS, you're required to explain the following qualitative characteristics. So they want you to explain relevance, comparability, understandability. So 6 marks. I mean, just give short. I explain all of these things in detail to you. This one, they want you to explain substance over form and going concern. Even today, I explained substance over form to you. So all of those things, please go and read. They are very important. If you take your time and read this, and you are supposed to be reading it every time. So another one, it says, X Limited commences business on 1st January with a single item of inventory, which costs 10,000. During the year, it sold the item for 14,000 cash. Now said, during the year, general inflation is 5%, but the inflation specific to the item was 10% required. Calculate profits in each of the capital maintenance concept. Okay, I think I should solve this one for you. So under financial concept of capital. Okay, Ogechukwu said 3,000. That's, which one? Which of the concept? Just said 3,000. Under financial concept of capital, how much was sales? Sales is 10,000. How much was no, sales is not 10,000. Sales is 14,000. How much is the cost of sales? That's 10.
10,000.
How much is our profits?
4,000.
So under physical concept of capital, what's our sales?
10,000. Sales is 14,000.
14,000.
Sales is 14,000. What's our cost of sales?
10,000.
10,000. But physical concept wants to know what's this cost of sales today. not the cost of sales. So it will consider inflation. So what's the inflation? Are we using general or specific?
10%.
Specific.
Thank you. We are using
Is
specific.
1K. Oh,
Yeah, we're using 10%. So my guy was correct. Times 1.1. So that is 11,000, I guess.
Yes.
So what do we have as profits?
3,000.
We have 3,000. Okay. So and that's the solution to this. So and they have asked something like this before. I don't know why I put ICAN pack, but is a past question that they have asked before. Ah, okay. Sorry, Osuji. So this 10%. So if I want to increase this cost by 10%, I'll just do 1.1. So if you don't understand that, you can just do 10% times 10,000. It will give you 1,000. But this is a faster way. When you want to increase something by 10%, you just do 1.1. Okay? Yeah. Another one. This one says discuss the qualitative characteristics of that makes information useful to users. So 10 marks. So what do you think we'll be talking about here? Discuss the qualitative characteristics that makes information useful to users.
qualitative characteristics of a financial report.
Okay, so what are they?
Fundamental characteristics, enhancing characteristics.
So which one makes it useful? Is it fundamental or enhancing?
Both. Both of them.
Both. Both.
Enhancing makes it useful.
So
It's fundamental.
It's fundamental that makes it useful. Enhancing makes it more useful.
More useful.
Yeah, or less useful if it doesn't have it. But what makes it useful is, I mean, for this one, explain faithful representation and relevance very well. But that's what will give you almost all the marks. And you can just identify the one that makes it more useful. Comparability, verifiability, and all that. Yeah, all those ones. So this one says the conceptual framework of ISB states that there are two concepts of capital maintenance. It says explain the term financial concept of and physical concept of capital. So which one is this one? So you want you to explain this. I think this is the last one we did. Yeah, Moses, you have a question. Go ahead, please.
Yes, sir. I'm very sorry, sir. My network was having issues, so I didn't get that question 10. Sorry for taking it back. Yes, sir.
Okay, no problem. So
Thank
we
you.
determine profit under each concept of capital. For financial concept of capital, that one is straightforward. It's just 14,000 minus the 10,000. We got profit. But for the physical concept of capital, we needed to consider inflation in the costs. Yes, the sales is 14, but the cost of 10,000 is not the cost for physical. Physical would consider inflation. That was the cost today. So they gave us two inflation. They gave us general inflation and specific. We use specific because we are trying to calculate the profit on a particular item that you sold for an organization. So we use inflation specific to the item. So we increased the 10,000 by 10% to get our new cost. That was why we have 1.1. So we had 11,000 like that. Okay. So
thank you, sir.
Yeah, Moses. So for this one, they said we should explain financial capital maintenance, fiscal. We have explained this to you in your notes. You can check it out. So this one, for professional guys, they are talking about that we should explain the argument for and against introduction of prudence into the conceptual framework. I think this is for everybody. And I'm sure you remembered when we mentioned prudence. Who can remind me? When we're discussing conceptual framework, where did we mention prudence? Say it again.
Under faithful representation, that we should report it the way it is. That we should be prudent in our reporting.
Yeah, that's correct. Yeah, that's correct. Under faithful representation. Thank you, Ogechukwu. And specifically under neutrality. Specifically under neutrality, we mentioned prudence. And I explained prudence to you, if you remember. I said prudence means that don't overstate asset and income. Don't understate
liabilities
and that's is in the meaning that you build all your arguments for and against. Okay, because with the introduction of prudence now, you would ensure that entities would make sure that they capture the actual value of their assets. Their assets are not overstated. They would ensure that their income are not overstated. And you will appreciate this more. This kind of question, if I give you solution, you just be cramming now. You appreciate it more when we move into areas like impairment. Okay, by testing an asset for impairment is prudence, because impairment ensures that you are not overstated.
Yes.
For items like revenue, for example, IFRS 15, for the fact that you collected money does not mean that you can recognize that money as revenue. You can only recognize revenue when you have delivered, when you have performed, when you have satisfied performance obligation, when you have delivered the goods or services. That's when you can recognize revenue. But if you can't remember those details, the argument for will be things like you can give them that general, ensure you don't overstate your assets, you don't overstate your income, ensure you don't understate your expense, you don't understate your liability. You can give them that general one. However, for the argument against, then you'll be looking at the fact that it increases, it enables, it gives opportunity for manipulation of reports, right? Because now we are saying you should be prudent. You should not overstate, meaning that you have to ensure you impair your assets. You have to ensure that you properly depreciate your assets. You have to ensure that when you have to make provision, you make provisions. All these areas of prudency that ensures that you do not overstate these items or understate them, they are based on estimates. They are all based on estimates, which gives room for manipulation of reports, which gives rooms for creative accounting, which gives rooms for difficulty in comparability and all of that. So these are ways in which you can build points in your, this is not a question they can ever ask you again. Identify two of the concepts of asset and liability, which definition was revised, and justify reasons for the revision. So this kind of question is relevant when they just introduce the new conceptual framework and they change definition of asset and liability. Even me, I can't remember the old definition. If they ask you a question like this again, all you just need to do is just to explain the new definition to them, because we have forgotten the old definition. Explain the new definition, explain definition of assets, all those major elements, economic resources, control, explain the definition of liabilities, explain present obligation, and all that. Then you will have taken care of a question like this. Okay. Yeah, gift, I can see your hand.
Okay, thank you, sir. Sir, please, I just want to ask a question. Before you send these materials to us, will you answer all the solutions?
Yeah, do you want me to put the solutions there for you? I can put
Yes,
it.
please help us. Have mercy.
Okay,
So
I'll
that
put the solutions.
it will be easy when we want to read, and we can retain
You
when
don't
it's
want
exam period.
you don't want to attempt. I'll give you assignment. You will not do it. Now you want me to put all the solution. I'm not going to put it.
think
I'm not going to
without
put it.
the solution, it will be easier for us to actually learn better. We cannot.
Yeah, I
There are
agree
past
with
questions. We can go and source for it.
I agree with you. That is easy for you to learn. Yeah, I agree with you. But I will put this one for you. But the next assignment I'm giving you, I'm going to be only sending this solution to people that do my assignment. If we don't do assignment, I will not give you solution to this past question. You can go and source it in ICAN Path. Yeah, you can go and source it. But the reality is that the solution there, you find out that it's actually difficult to comprehend because they will just write everything. They will put everything there. So I would send the solution for this one to you, no problem. But note, solution is based on doing of assignments, especially for past questions. So I'll give you the solution I solved in class and all of that. So please note that. So there are a lot of other questions here. Okay, so Evelyn, please send me your assignment. Since you said you do it, I'll be expecting your assignment immediately after this class, Evelyn. Since you said you have done my assignment. So, yeah, so you can look at question 13. Question 14. Yeah, let's look at question 14 together. There are plenty questions here that I have here for you. Plenty. So let's look at this question 14 together. So this one says that, let me check the requirement. It says, assuming the above figures prove to be accurate, prepare extracts from the income statement of Wasil for the 3 years to 31st March 2012 in respect of the above transaction, reflecting the legal form of the transaction. 2, reflecting the substance of the transaction. Note that financial position extracts are not required. The following mark allocation is provided as guidance for these requirements. 1, 2 bags, 2 3 bags. Okay, so let's look at the question. It says, Wasil's activities include the production of maturing products, which takes a long time before they are ready to retail. Details of one such product are that of 1st April 2009. It had a cost of 5 million and a fair value of 7 million. The product will not be ready for retail sale until 31st March 2012. On April 2009, Wasil entered into an agreement to sell the product to Easy Finance for 6 million. The agreement gave Wasil the right to repurchase the product at any time up to 31st March 2012 at a fixed price of 7.9 million, at which date Wasil expected the product to retail for 10 million. The compound interest Wasil would have to pay on a 2-year loan of 6 million would be year 1, 1.600, year 2, 660, year 3, 726. The interest is equivalent to the return required by Easy Finance. They want us to prepare an income statement using legal form and using substance. You know that this question is good. Reason that we have explained substance over form. but we did not really solve any question. I just explained it. So this is a question on substance over form. So they gave us a scenario. They now said we should prepare P&L using legal form and using substance. Fantastic question. And what this question is talking about is the fact that there's a company that manufactures a product, and this product takes a long time before they are ready, right? So they now say one of that product is a product in 2009, which cost 5 million and has a fair value of 7 million, right? And the product's fair value is selling price, I'm sure you know. And the product will not be ready for retail until 2012, right? So in 2009, he now entered into an agreement to sell a product for 6 million. And don't forget that this product, you cannot really retail it. It cannot be available to the counterparty, to the buyer until 2012. But at least, because maybe people want it so much, he entered into an agreement with somebody in 2009 that is going to sell the product for the person at 6 million. And the agreement gave this company the right to buy. You can buy the product back before that 2012 for a fixed price of 7.9. Okay, that yes, I've agreed I will sell it to you for 6 million when it's ready. But before that date, I can say, okay, I want to buy it from you back, but for 7.9 million, which makes sense. So, and at that date, the selling price of that product will now be 10 million. So he now said that if this guy if he had borrowed 6 million, he will have paid interest of 600 in year 1, 660 in year 2, and 726. So apparently, this guy actually gave him 6 million. It's just like all these developers that will do kakas and they will say, yeah, come and pay, come and buy it at small money today. Right? So that they will collect money, but they will not give you possession until when the product is complete. Something like that. So now, how do we prepare this? Using legal form. Legal form will recognize 6 million as revenue in 2009. Because legal form, since we have entered into an agreement and that I'm going to sell to you, so you recognize revenue that I've sold. And the historical cost is 6 million. Okay? In 2012, assuming he repurchases it back for 7.9, so the cost of sales is 7.9, he can resell it for 10 million. So profit is this. So this is the total. And that's it for legal form. But for substance cannot recognize revenue until he has delivered the goods. That's substance. Until there is a risk, there's a reward, which is 2012 when the goods will be ready for retail. And at that date, he sells it for 10,000. Of course, the cost is the historical cost, which is the cost of the goods at the date of acquisition, at the date of manufacture, which is 209. That's how much we are still going to recognize. Okay? And substance is going to recognize the fact that since you collected 6 million from the person, even though you are not paying interest directly, but if you had gone to borrow that money, you would have paid interest. So it recognizes finance costs for each year, right? Then it gets profits. And this is the total. Even though the two are giving us total net profits, but the timing as which each element of that profit is recognized is different. So these guys, the way they recognize the item is different. Legal form, that one is based on agreement. Substance is transfer of risk and reward. That's where this is recognized. Okay, and there's another question that you can also look at as well, and there are plenty questions that you can practice. Okay, yeah, please ask a question. I can see your hand.
Okay, sir. So I just want to ask that revenue from contracts that the obligation is not yet fulfilled, is it an example of the substance? Can it be classified as an example of the substance?
Well, I won't say example of a substance. I will just say based on substance, you will not recognize revenue. Based on substance, you will not recognize the revenue because you have not performed, you have not delivered. If you have performed a portion, then you can recognize revenue to the extent of that portion, right? If you have performed everything, you recognize revenue on everything. Love it. Did I answer your question?
Yes, sir. Yes, sir. Thank you, sir.
Okay, so I will put the solution to these questions and I will share it with you.